Wednesday the 15th of February. Let's take a review of how things finished last night and then some of the news from overnight and what we're looking out for in today's session. Starting off, US equities just continue to really power on all the way into the close. Looking at the Dow, this is something we've it's almost like an in-house joke. It's like when equities move anywhere lower, it's at what point do you just get long for the eventual ramp into the close? Still seems to hold true at the moment. I guess it's a bit of a Goldilocks type scenario, which we'll talk about shortly, in which you've got low interest rate environment, at least, although March odds have bumped up. It's still more priced in for a hike not until another few months' time, well into the summer, into June. And then you've got the kind of corporate tax element for Trump, and that's helping boost some of the financials and other firms as well. So another simultaneous record close across the major three US indices last night. The S&P Financials Index, that was drawed a bit of significance yesterday because, in particular, Goldman Sachs, they closed above the pre-financial crisis high and at their highest closing price ever. Again, this is a company that has essentially risen somewhere like 35, knocking 40% since Trump came in. And so equities continue to be elevated in this kind of market environment. And again, it's kind of a dual force of no immediacy to a rate hike, keeping a fairly accommodative stance, a kind of straight bat, as you would say, from what Janet Yellen was playing yesterday, keeping things on track, but with a more cautious, if not a tinge of hawkishness in the approach. But then the fiscal element, corporate tax potentially, this phenomenal deal that's said to be coming from Trump, or together with the relaxation of rules, particularly around financials, is helping elevate the equity market. Currency-wise, the dollar is still a touch firmer this morning. It's actually the dollar index trading up and around its highs that we had immediately after the statement from Yellen. So just keep an eye on these currency pairs this morning. Still a little bit of dollar strength. Looking at euro dollar, we're just touching session lows. You can see in my charts top left as I speak. And that's that line of kind of support that we had yesterday evening and also overnight, really. Likewise, cable. I'd be keeping an eye on a similar associated low print from post-Yellen yesterday. That comes in at 24.49. So seeing about 20 pips above that at the moment, but euro testing it. And below there you've got S1 coming in at 05.59. Taking a look then at Janet Yellen. There's a few things we do need to just quickly recap, and it will make a bit more sense and why the markets have probably reacted the way that they have done. And these are 5 takeaways from Janet Yellen's testimony before Congress, and I have emailed this out to you, so please do have a read. One was there was a touch of a hawkish sentiment, and you certainly saw that in the initial knee-jerk reaction in terms of dollar strength and a spike in US yields. You can still really see that quite clearly on your T-note chart. If I move over the bottom right-hand corner here, you can see that really strong downtick that we had in immediate fashion. And really that was because of the way in which news agencies report the news. The market always tends to take a bit of a knee-jerk reaction in toward the main headlines that are identified by someone like Bloomberg. And in this case, that was pretty clearly run as waiting too long to remove accommodation would be unwise. That then is a bit of a new phrase, if you like, from Yellen. It kind of steps up the intensity, if you like, that they're willing to commit to fulfilling their objectives of 3 hikes this year, and the market reacted accordingly. They also, within the statement, Yellen, incoming data suggests that labour market conditions continue to strengthen and inflation is moving up to 2%, consistent with the committee's expectations. So on those metrics, you would say, wow, this is really quite hawkish on that alone, and that is what the market really jumped on to start with. Going through though, what that really led to was, although in summary it was a little bit more balanced overall in the delivery, market expectations did bump up a touch for the probability of a March rate hike, But if I bring up this graphic so you can see it, make it a bit bigger. The odds of a March rate hike rose to about 36%, I think it was, from 30% by Bloomberg's measure. So certainly it's definitely not priced in for a March hike. We're priced in for a June move from the Federal Reserve. That has not changed. What we heard yesterday was enough to have the market reevaluate slightly in terms of, I guess, the probability's gone up. She later said in a Q&A session that every meeting is a live meeting. And I think you'll remember me saying yesterday that's exactly what I thought she would say. I think it's very much Fed tactic to keep every option on the table, should they so wish. And so that doesn't really surprise me too much. So odds have increased, but not enough then that it's really changed the game in terms of the market's timing of when they think the Fed will act. The other big things here, which probably helped the equity market rally, was that Yellen said she supported the core principles in Mr. Trump's recent executive order on financial regulation. And there's been a lot of, I guess, from a political element, a bit of a pushback in regards to, wasn't it loose regulations that led to the financial crisis in the first instance? Well, Yellen is supportive of Trump in some respects. And actually, she says that certainly do agree with the core principles. And as such, financials, as I said, were the better performing as a sector breakdown. And Goldman Sachs, as we said, are now above their pre-financial crisis levels. The other thing as well that's a positive in terms of equities, there was little detail on the Fed's balance sheet. So there was little detail offered on the closely watched issue of when the Fed will start to trim its balance sheet, which is particularly important for the mortgage market due to the large holdings at the central bank. Yellen said, "We want to wait to start this process until the process of normalization is well underway." So what she's basically saying is that they're not going to look to reduce the balance sheet until they've gone into a series of rate hikes to come. That means then that, again, there's no threat of that more hawkish element coming in of a reduction of the balance sheet. So that's a net positive as well in terms of the equity space. The more kind of, I guess, even-handed approach that maybe makes this not a runaway hawkish situation is that Yellen did go on to say that policy changes provide considerable uncertainty. So the chair confirmed that it was too early to know what fiscal policies would be put in place under a new Trump administration. That is undeniable because there is no details, so to speak, at this point. And as such, actually, I think what you heard was none of yesterday really surprises me. I guess it's just the way in which the market was positioned. Maybe was for not something quite as direct as upping the kind of prospects of all options being open by suggesting that removal of accommodation, if it took too long, would be unwise. Maybe that was a little bit more punchy than the markets were positioned for. But otherwise, I think, as I was saying, it kind of leads you into this Goldilocks scenario of a low interest rate environment, deregulation of the market amid a fiscal boost from lower corporation tax. That is why equities are at these simultaneous all-time record high levels. If you think about it as well, if you start getting agreements on the regulation side and he delivers on the corporate tax side, you would think that that would achieve then a economic boost, a stimulus to the US economy, and the dollar should rally. And therefore, although the Fed might not hike in March, I think the one thing she made clear yesterday is that she definitely does not want to be remembered as a person who's behind the curve. So then, what's not to say that there's an interim move outside of the Yellen press conference summary of economic projections between March and June? That is possible as well. Otherwise, looking elsewhere then from overnight, you'll recognize that oil prices have by no means seen anything like the same sort of size move that we saw this time last week. Let me just highlight the area I'm talking about. It's here. That was the release of the API crude oil inventories last night. So for those who didn't catch them, remember, put it in a bit of context, last week was the second largest build in US history, in excess of 14 million. So the benchmark, if you like, is quite high in terms of the value of upside builds. And yesterday it came in, it was a build, again, large size, 9.94 million, was above the expected 3.5 million. Cushing, though, was a draw of 1.25 million against expectations of a build of 500,000. So you've got a bearish headline, although not quite as large as what we had last time round, but the Cushing number was bullish. The gasoline was a build of 720,000, there's still a build of 1.5 million. So this is the 6th weekly build in a row for crude now, the 3rd week of major builds. There was a little bit of a downtick in oil, but again, as I said, nothing to really compare to the size of move that we had yesterday. So maybe a bit of a proportionate desensitization by the market to these larger builds, given it's the third week in a row. It's also the 3rd weekly build for the crude headline, and also you had a bullish Cushing number to counteract that weakness, if you like, that emanated from the build in the headline crude figure. So a couple of reasons there to maybe negate that move. And certainly, as per usual, those numbers will define our expectations for the data which we'll get from the Department of Energy later on today. Okay, quick look at the calendar. So 9:30 we get jobs data coming out of the UK. Now, questions I normally get are about what tiered are these data, i.e. the CPI yesterday being tier 1 from the UK. What is this jobs data? I would say this is very much a lesser priority from a policy point of view, given the health of this particular sector of the economy. So I'd probably put it down at tier 2 at this point, so not majorly market impactful. Reasons for this, well, last time, in terms of people claiming benefits, that was down substantially last time. So that situation was pretty good last month. And really what I wanted to show you here was the unemployment rate in United Kingdom, which is currently at 4.8%, has been for a while now. The unemployment rate held at this level, which, as you can see, sub 5%, we're already in a better situation than when we were pre the financial crisis, when obviously we had a big spike in unemployment in the years thereafter. But pre Lehman's and so on, we were tracking at around just above 5%. We're already below that. These numbers very rarely deviate too much in terms of incremental changes on the unemployment rate month to month, quarter to quarter, and as such, again, the reason why this isn't too important is because it's not really going anywhere fast, and it's a good situation the Bank of England doesn't need to be concerned about when they're more concerned about price pressures in the economy at the moment. So I'd keep an eye out for that data, UK traders, for the FX and sterling currency. Obviously downside, we've already seen, as I've been talking, euro made a bit of a concerted break there on that low from yesterday, quick run down to S1 before bouncing here. So likewise, I'll be keeping an eye on those levels as well on the downside in cable. Otherwise, just moving over to the US session, and it's an extremely busy one today. You've got CPI, retail sales, New York Empire State Manufacturing, capacity utilization, industrial production, manufacturing production, US NAHB Housing Market Index, business inventories, and then you'll get your crude oil inventories as well. And you've got Donald Trump meeting the Israeli PM as well. So a lot on the agenda for this afternoon. So you know what that means. You should be preparing accordingly for most, I would say, of the action to come in the afternoon. Not only because the fact that you have lots of scheduled economic data and important speakers in terms of Trump meeting Netanyahu, you've also got Yellen appearing in front of the House, albeit that will be a repeat event. But if you think about it, what was the driver of the financial markets? It's still being US led at this point from a global macro perspective. Yes, in the background there is concerns still there about the French election race. There are still questions about the Dutch election, which is upcoming on the 15th. So this time next month we'll know the outcome of that. But the US and Trump and what we had yesterday from Janet Yellen is still the dominant force. So as such, accordingly, when you're planning your strategies for the trading day, when you've got a light morning like this, maybe you're better off thinking about your game plan for the afternoon, because that's where the order volume will pick up and you'll get more substantial movement in the market. Looking at the US data, just having a quick look at Barclays, they're saying that they expect headline CPI positive energy base effect should continue to boost headline inflation in Q1. In addition, they expect a gradual firming in core inflation with a diminishing drag from core goods inflation and a continued increase in core service inflation. So generally speaking, like many of the other continents at the moment, we've seen through mainland Europe, in the UK, albeit at a slightly slower pace than some had expected, but inflation has been on the increase. We're anticipating the same to be the case here in the US data this afternoon. Retail sales as well to look out for this afternoon. I'll pop this into the chat room so you can have a read. It's Barclays, Bank of America, a few other banks, insights as to what they're expecting for the data later, which we'll run through in more detail, of course, ahead of the release itself. Whenever, though, you've got a calendar, when there is a multitude of different economic data points coming out, the thing I guess you need to do is kind of prioritize your day in importance value. So when I'm looking at these data points, again, you kind of refer back to what is it that the central bank themselves of that country are focused on most. And similar to the UK, the US are not so concerned, I'd say, about the job situation in terms of job creation. The wage, if you remember, data was what we saw for non-farm payrolls. It made that overall report quite weak. And it's also inflation that the Fed are concerned about. So I'd say the CPI numbers and also consumer health, i.e. benchmarked by retail sales, are kind of your two headline readings out of the plethora of data that's coming. All inventory data, I think, is, for the newer guys, certainly when you're not trading oil outright, I would say it's not really that much of interest for broader other asset class movement, i.e. equities, if there's any read across to the energy sector. I would only be expecting this to cause a brief period of volatility in crude itself, but ultimately, having had already 2 weeks back to back of very large size headline crude builds, I don't think the market is now that fussed about the supply situation when it's been more focused on of late. What we have seen is a bearish report from an inventory perspective, followed by a big rally in prices as the market kind of uses these lower price point opportunities to get long again, given the fact that demand is increasing. We've seen that in the EIA report earlier this week, and also OPEC compliance of their crude oil production cuts continues pace at numbers of like 93% or so at the moment, which is unprecedented. And I think that is underlying a lot of the sentiment at this given point in time. Okay, so that's pretty much your wrap for this morning. Equities then on the front foot, bit of a further digestion of continued move higher in US equities. The kind of agreement from Yellen on the regulation side in combination with the fact that financials then rallied on the back of that. You've got rates probabilities have propped up slightly, but still not enough for any immediate hike, so providing still a fairly cautious approach from the Fed. You've then got corporate earnings coming out of Europe this morning. Just to give you a quick overview, you've had the likes of Credit Agricole, they're up 3.5%. Heineken are up 3%. Euronext, the exchange, are up 2%. So earnings as well, still ongoing in Europe, likely lending a bit of a hand of support as well. Okay, so have a good session. I'll see you in the chat room. Remember, a lot of the activity is likely to come this afternoon. So maybe a degree of just patience would be a wise thing this morning, unless obviously a clear opportunity does arise. Okay guys, thanks very much and have a good day.